Okay, welcome to the May 9th edition of the Fats, Fuels, and Oils webinar. This week, we are going to preview the upcoming WASDE report on Friday. That report will be the first report that will include USDA's predictions for 2023-24. And so we'll show ours, and then we'll see what USDA says on Friday. And next week, we will not have a webinar. Next week is our conference. And so I hope to see a lot of you there, most of you there. Please feel free to say hi. The other thing that I want to say is I had been under the impression that when I updated the spreadsheets that feed into the website, that they updated the website, whether I published a report or not. And last week, I found out that actually wasn't true. So this week, I am going to publish a report. It may be really, really short because right after this, I'm leaving to go to some training. But going forward, since that doesn't happen, there may be weeks that I publish things that are literally just a paragraph. But if that's what we need to do to get the data updated and make it look like I'm not forecasting 70-cent oil, then that's what we're going to do. Anyway, all right, so let's get started. All right. So the first thing we'll do is talk about U.S. soybean oil. You can see that even next year, even though we've got crush going up from 2.225 billion bushels to 2.375 billion bushels next year, we still expect soybean oil stocks to remain relatively tight. However, our forecast for crude soybean oil prices in central Illinois has declined year over year from 61 cents roughly in 22-23 to 54.5 cents. That's largely due to the stuff that we've been talking about, the likelihood that a large crop or a trendline crop in the US and trendline crops in South America could pull soybean futures down to $10 or maybe even lower. And as a result of that, I think that while the demand will support soybean oil at the upper end of that historical relationship still holds, even if it is the relationship is adjusted a little bit higher, it still holds. And so it looks to me like that's probably the range that we're going to be in if you want to kind of say fair value for soybean oil, crude soybean oil in central Illinois next year is between 50 and 55 cents. That probably puts RBD at around 60 to 65 cents, somewhere in there, and puts futures probably closer to, probably in the same range as crude, around 50 to 55 cents. You can see I had, before I sort of really started to get ready to display this, I had kind of a placeholder in US imports of 2 billion pounds. And that's kind of about where the shortfall lies if you look at our projections for feedstock demand and in the feedstock demand for the other feedstocks, for the low CI feedstocks. However, I took that out. I used to sort of always show those big import numbers, but now I want to show where I think ultimately we really end up. Part of that went to some of the low CI feedstocks. Part of it also went to offsetting the decline year over year in non-biofuel usage. Now, I think non-biofuel usage is one of these things like exports, where as an analyst, I predicted that exports would decline sharply for 2 years before they actually did decline pretty sharply. And I think it seems obvious that non-biofuel will probably have to tighten up. And we've talked about substituting palm oil for soybean oil in some of the feed rations, and canola oil for soybean oil in some of the food industry. So I still think that that's going to happen, but it's sort of that same thing. Like it looks obvious and it looks like it needs to happen. It looked like it needed to happen this year. And this year, non-biofuel demand is as strong as we're predicting, or potentially even stronger than we're predicting. And that's in part because, and this is something else that we've talked about, a lot of non-biofuel end uses, the portion of the total cost curve that's represented by soybean oil is relatively small compared to biofuel, where feedstocks make up obviously a huge portion of the overall cost curve. So it may be that ultimately I just keep predicting 14 billion pounds or 14.5 billion pounds of non-biofuel use going forward forever, and have to figure out other ways to make the balance sheet balance. But I'm going to give it one more try for 23, 24. The other thing that I would note is that we're using 11.85 pounds of soybean oil per bushel of soybeans crushed. So our crush number is relatively big, and our yield is at the upper end of the historical range of the last couple of years. And that will depend largely on the weather in the Corn Belt during the end of the summer, while the soybeans are actually filling their pods, on whether that number is actually achievable or not. Right now, it helps me balance the balance sheet, and it's not hugely out of line with where we've been the last couple of years. This year, yields are lower, but the year before that, they were in that range. So if it is sort of, instead of 11.85, it's 11.75, then you have to find another 230 million pounds or so of soybean oil, I think, if I'm doing the decimal shift correctly, which I am horrible at. And so it can be something that will require further adjustments as we get through the end of the summer and we have a better idea of what we really think the soybean oil yield is going to be. But I think it's worth pointing out right now, because I think that is outside of the obvious sort of, will we grow biofuel feedstock demand by this much, and will non-biofuel demand hold up? I think that's probably the key unknown for 23, 24, that and probably the crush total. Soybean oil exports, we got data from census this week, and it showed that in March, not a big surprise, soybean oil exports remained down pretty substantially relative to history, but in line with expectations given where we've been so far this year. The surprising bit was last week's export sales report, and based on last week's export sales report, we kind of look at the export shipments, and we use those to estimate what census is going to say before we actually get the census number, since it comes out a month afterwards. And so last week there was a big bump in export sales and shipments both. Somebody bought a bunch and shipped it out directly, or bought a bunch relative to the rest of this year. And however, if you actually look at the export sales data, you can see that we typically get a bump on that week, and it's not unusual to see weeks or periods like this where it's obvious that somebody comes in and buys during that week for some specific purpose. I don't actually know what that is, but it almost matches down to the pound what they bought last year. And if you look at the 5-year average, you can see there's a little kink there in the 5-year average that roughly matches what we saw last week. So I think that's a one-off. I don't think that that's repeatable or the start of some new increase in export sales, because we've had this decline in prices, in part because I think other vegetable oils are also remain really competitive compared to soybean oil, and particularly soybean oil from the US. And so we don't really expect that we're going to see that continue, and don't expect to take our export number up. In fact, we took our export number down this month based on the census data to 250 million pounds, I believe, which would be a record low going back to the early 70s at least. I'm sure we exported less at some point, but in the time that I have history for, this would be a record low. For canola oil supply, the big shift from this year to next is in our import forecast. It could be that imports continue to run at about 5.5 billion pounds, or maybe a little bit more than that. If you look historically, and we talked a little bit about this, the bulk of our canola oil imports obviously come from Canada, and that the difference between U.S. imports and Canadian exports to the U.S. has been relatively modest going back for the last 5 or 10 years, but it's averaged about roughly 200 million pounds over the last couple of years. Before that, it was even less than that. This year, we're starting to use 750 million pounds, which is up from, I think the last time I talked about this, we were at 450 or 500 million pounds, as more imports continue to come in. And next year, we're not going back to 200 million pounds, but we're not at 750 million pounds either. Now, ultimately, we may need to raise it back to 750 million pounds. But part of that will depend on production in Europe and in Australia to see if the crops there are large enough that they can export a substantial volume of canola oil to the U.S. The other thing I think that I would note is that at least right now we've got biodiesel, and that's really should be biomass-based diesel, feedstock demand down slightly. That's largely on basically steady use in renewable diesel production, and then a decline in biodiesel production. The decline in biodiesel production, I think, is one of the questions for 2024 that we will need to kind of go back and revisit a little bit. We hadn't really thought that biodiesel production would decline sharply in 2023, but we started to build in declines in 2024. And given where margins are right now, it seems likely that we're going to need to raise our forecast for biodiesel production. That goes back to the long-running argument that I've had with myself and conversations that I've had with others about, based on the implied volumes from the mandates, if you don't get rid of some biodiesel capacity, what does that imply for renewable diesel capacity utilization? That's what's driving the decline year over year right now. I still haven't settled on exactly what I think about that and where that is going to end up. It's very hard for me to kind of think that unless we start to see a significant pressure on biodiesel margins, that we're going to see the type of drop that we have built into our forecast for biodiesel production in 2024. And if that's the case, then I think you would probably see 23-24 feedstock demand for canola oil closer to or a little bit above where we are in 22-23, so around 2 billion pounds, call it. Given the year-over-year decline in imports, it'll be relatively easy to sort that out, with an expectation that imports will probably rise as long as the crops are available in the other countries or in Canada. And so there's a little bit here that I probably will ultimately end up changing not in reaction to whatever USDA says on Friday, but more in reaction to, again, what I really end up sort of thinking about biodiesel production in 2024 and what that implies for not only biodiesel feedstock demand, but renewable diesel feedstock demand as well. This is just Canadian canola oil exports, and you can see that for March, canola oil exports were at a marketing year high anyway. I look back when I put this slide together, the slide that the last time I guess I included this in the presentation was after we had gotten the January data. And so if you looked at the forecast for February and March, at that point, we had February higher than it came in and March kind of lower than it came in. So I think on balance, I think those two I think the total for those 2 months is probably not far off our expectations. It's just the month that the shipments came in. Exports have been really, really strong, and that is we're going to go through the Canadian canola oil balance sheet here in just a second, and I'm going to talk about Canadian canola seed crush versus exports. The canola oil exports remain something that is obviously a plus for the crush demand. And in addition to that, I think that if you look at U.S. imports of canola meal have been really strong in the last couple of months. And so there probably is real support for canola crush. However, as you'll see here in a minute, Canadian canola seed exports have also remained really strong. And so this week I took crush down a little bit and exports up, but again, I'll go through that in just a second. For Canada, I think the biggest difference really is in domestic usage, and I need to break this out so that you can see the growth in biofuel demand, biofuel feedstock demand versus food demand. In 22-23, we actually have domestic usage down a little bit just based on the strength of exports and like I said, sort of a limited availability of canola seed for crush, or at least at this moment, it looks like that's the case. There's a fairly large residual number in the Canadian canola seed balance sheet that moves around and can vary from 200,000 tons to negative 200 or 300,000 tons. And that gives you a lot of room to kind of add to both crush and exports. Right now, I'm keeping that sort of in line with where it's been the last couple of years, but that number could come down if we don't see a slowdown in either exports or crush. And in the bulk of that decline, at least so far, has been in non-biofuel demand. If you look at food demand, it's relatively steady year to year. If you look at non-food, non-biofuel demand, it doesn't move around too much, but that's where a lot of that decline is coming from, just based on the fact that there's sort of limited supply. They're exporting a ton of canola oil, and so we have to reduce usage someplace, and that's kind of where it ends up falling out. I think ultimately the question will be similar to the US. How much does that non-biofuel demand decline sort of in the long term? In the case of Canada, I think it's less about biofuel feedstock demand and probably more about exports to the US for the food industry, and to a lesser degree for biofuel feedstock demand. But next year we have that coming back, in part because we've got crush. The crop next year, assuming it's trendline, should grow enough that that it supports crush and exports at a level that allows food demand to remain where it is, which is essentially, it's a little less than 100,000 pounds or 100,000 tons, and non-biofuel domestic demand to come back to where it has been traditionally. And you can see the difference in production is largely due to that increase in crush from where we are this year to next year, which is much closer to sort of the record that we set in 2021. So this is the really too busy chart that shows how the Canadian oilseed industry is using canola seed, exporting it or crushing it. And you can see that both have been really strong relative to last year, certainly given the drought restrictions or the drought reduced supply last year. Exports have been significantly stronger than expected, and it may be that I really need to continue to raise my export number going forward, because it seems unlikely that we're going to get this huge drop off in the April data, and that we're going to stay there through the end of the year. But there isn't enough supply because stocks are already relatively tight, or my stocks forecast is already relatively tight. And so it's kind of a zero-sum game. If I raise exports, something else has to fall other than stocks, and there isn't any more production come in or imports come in. And so it probably ultimately will be that residual number that I end up changing. But I just haven't quite gotten the gumption to do it yet, or haven't been convinced enough to do it yet. I'm not entirely sure what it's going to take to convince me, because the last 3 months should have obviously done it. But that's kind of where we are now. And like I said, what I would expect is probably that I will ultimately end up raising my export forecast and potentially my crush forecast. If crush came down to 9.9 million tons, I'm not 100% sure that I think that crush is going to remain below 10 million tons by the end of the year. Exports came up to a little bit over 8 million tons. That could be, I think USDA in April was around 8.45 or somewhere in there. That could be even a little bit low, and I may need to raise exports by 750,000 tons or something like that. That would flip the residual negative. I might also end up trimming stocks slightly. I've got a little bit of growth year over year in stocks from, I think, like 750,000 tons to 900,000 tons or something like that. But there isn't a ton of room to cut stocks down. And so the bulk of whatever that change is, since it doesn't look like it's going to come out of crush any more than I've already taken it down, and in fact crush may come back a little bit, is probably just going to be in that residual number. Finally, on to palm oil. I think the most surprising thing to me about this balance sheet, we've kind of gone through a period where Malaysian exports haven't been that strong, and if you look at, over the last couple of years really, but if you look at the broader picture of Southeastern Asian palm oil exports, this year it looks like the total is going to be, or this marketing year is going to be 44.7, almost 45 million tons, up almost 10 million tons from last year. And the bulk of that is really out of Indonesia, where if you look at Indonesian exports, and we'll do that here in just a second, or we'll look at Southeastern Asian exports. But Indonesian exports are up pretty sharply during the first 6 months of the marketing year relative to the same period last year. Outside of that, on Malaysia, the only other thing I would note is that while the ending stocks remain above 2 million tons, which again is sort of our bullish bearish line, they get closer to 2 million tons. And if export demand is a little bit stronger than expected, or production is a little bit less than expected, it would be very easy to get Malaysian export or Malaysian ending stocks back down below 2 million tons. And given the spread between soybean oil and palm oil, which has tightened substantially since last summer, but still remains sort of historically wide, there is room for palm oil to rally without kind of upsetting the normal market dynamics that we see between the two prices. And so it wouldn't necessarily surprise me if at the end of 23-24 Malaysian ending stocks were down below 2 million tons. And it also wouldn't necessarily surprise me that if Malaysian palm oil stocks were above but close to 2 million tons, that that spread between palm oil and soybean oil may continue to narrow as palm oil remains relatively well supported, and falling soybean prices kind of drag soybean oil prices down with it. Again, so this is Southeastern Asian palm oil exports for the marketing year so far. You can see that they've been really strong up to March relative to last year in the 5-year average, and they've grown steadily over the last couple of years. And again, if you look at just Indonesian exports for the first 6 months of the year, they're up about a little bit more than 4 million tons from the same period last year. And that's happening despite the fact Indonesia exports a fair amount of oil to palm oil to Malaysia. When Malaysian imports go up to 1 million tons, the bulk of that comes from Indonesia. And so that exports have grown 4 million tons. And so, 1 million tons or whatever the change in Malaysian imports is not that significant compared to the 4 million ton increase. But Malaysian imports aren't really above 1 million tons this year, and they've come down a little bit from where they were last year. And so that just kind of shows the strength of demand in other areas. And one of those areas is the US. And one of the things that I'm going to focus on in my presentation at the conference is kind of, somebody asked a question last week, sort of, if based on that chart that I showed that showed the growth in renewable diesel capacity, and somebody asked a question, where are we going to get 7 billion pounds of feedstocks? And so what my presentation at the conference is going to kind of focus on is, where are we going to get the 7 billion pounds of feedstocks? And is that, do we really need 7 billion pounds of feedstocks? But part of that is kind of solving the puzzle of how much palm oil are we going to import? How much do imports of the low CI feedstocks remain elevated or continue to grow? Tallow is sort of the one of the really good examples. Used cooking oil is obviously the other really good example for import demand, and how much additional import volume can the U.S. take in of UCO, or how much additional import volume is available for the U.S. to absorb from UCO. But that's kind of what I'm going to take a deep dive into in my presentation, because I think that, again, if I just sort of put the balance sheets together and kind of leave everything around where it's been trending for the last couple of years even, you still get when you balance everything out, you still get kind of a deficit that I end up, at least initially, always representing as an increase in soybean oil imports. However, it's unlikely that the U.S. will ever import 2 billion pounds of soybean oil, given the 19% tariff on U.S. imports. And while there have been efforts to get that tariff reduced or repealed, so far I haven't heard of any real significant movement on getting that tariff reduced or repealed. And I think that it probably is more a shift in the composition of demand than it is something as simple as just importing a lot more soybean oil. My life would be a lot easier if it was just importing a lot more soybean oil, but not what is likely. Okay, so since the website hasn't updated, and it probably won't get updated until tomorrow or Thursday, since I'm going to be traveling, I wanted to run through what our current expectations are for prices going forward over the next year. And so you can see that we've got soybean oil futures kind of going down and bottoming out in the winter of 2024. That's primarily due to good U.S. crop, good Brazilian crop. Soybeans find a new equilibrium level, drag soybean oil down with them, and then you start to tick back up after that because you get the impact, the sort of the change in soybean prices stabilizes. And so then you're just left with the change in soybean oil demand. And given the fact that soybean oil demand should continue to grow, that's where you start to get the tick back up. And you can see futures are kind of around 50 cents. Of course, the week after I cut my forecast pretty sharply, we got a 2-cent rally in soybean oil prices broadly last week. And so that's just what usually generally happens. And so again, I think probably the fair value range is somewhere between 50 and 55. It wouldn't necessarily surprise me if over the course of the next year that line kind of shifted up a little bit. However, I think again, if we're thinking about sort of either the historical prices for corn after the ethanol build out, or the historical prices for soybean oil after the initial biodiesel build out, you get kind of the same pattern in both, where you get a lot of anticipation, a lot of speculative fervor, and prices go up and kind of blow off, and then they come down and they settle down to a new equilibrium level that is higher than the old equilibrium level, but not nearly as high as the highs, while there was a lot of uncertainty about what the industry was going to look like, how much soybean oil it was going to consume, or how the volume of feedstocks that were going to be required to meet the demand. And so I think that we're getting to that kind of final stage of this pattern, and then it just becomes kind of figuring out exactly where that equilibrium level is. A couple of months ago, I said that I thought that equilibrium level was probably 60 to 65 cents, and that was sort of based on the idea that soybean prices would remain a little bit higher than I think they're going to now. And so we've had another step down in our expectations, or our forecast anyway. And not saying that this will be the last shift down or shift up. It certainly won't be the last of either of those. But I do think that in terms of huge shifts sort of showing up one day and seeing a forecast that just goes straight up to the right or straight down is getting less and less likely, and we probably are getting closer and closer to the long-term equilibrium for soybean oil prices broadly. For RBD soybean oil, again, you see it's about 65 cents. The refining margin looks to be stabilizing around 10 cents. There still is a question about that margin. And again, if you sort of think of that margin as the crude basis plus the refining margin makes up RBD basis. Crude basis is settled down into it dropped down to 2 cents, or a little bit lower than 2 cents. It started to climb this past week, and I think there is still an open question about exactly what the composition of RBD basis looks like in the long run. And if demand for crude rises because most of the RD feedstock demand is for crude rather than RBD soybean oil, then I think you could have crude basis kind of staying, or you could have crude basis growing and then the refining margin coming down. That's something that I've thought would have happened, or at least started to happen by now. But I think that the learning curve or the startup for some of the renewable diesel plants has been a little bit steeper. And the other thing that has happened is the non-biofuel demand has remained relatively steady and relatively strong. If in the end the RD demand is crude and that grows, and we don't get a drop off in non-biofuel RBD demand, then RBD probably the spread between RBD and in futures probably ends up to be a little bit higher than we're probably reflecting here, because you'll have the crude basis rise a bit, and on top of that you'll have the refining margin remain steady or at 10 cents, or maybe even potentially grow a little bit. However, this is again sort of where we are now. If you look at the change for Q1, RBD basis is actually up a penny, which is a little surprising, and it's been kind of either unchanged or down maybe just a little bit, or up now about a penny for the entire year. And it looks like, given what we've seen in the last couple of weeks, it actually looks likely to strengthen in the coming months rather than weaken, I would say. Here's crude degummed. This is around 55 cents. And again, crude degummed basis probably around 3 cents, or between 3 and 5 cents going forward. A lot of that will ultimately depend on how much of that RD demand is crude versus how much is refined for non-biofuel use, or refined for RD plants that are starting up, or biodiesel, or other uses. And again, I think that there is probably a little more upside risk in the crude basis than there is in most of the other markets, of the futures market or the RBD market. Of course, the RBD market is a bit of a function of the crude market, but unless there is a significant difference between our expectations for crude demand versus what is actually realized, and it's hard to imagine that will occur, because so many of the renewable diesel plants have pretreatment or have announced that they're going to have pretreatment. And if they do that, then there isn't, I suppose there could be reasons why they would still buy RBD soybean oil, but in general, I don't know why they would pay 10 cents more for RBD soybean oil if they can refine it to their spec on site with their other feedstocks. And so in the end, to me, that reduces the upside risk for the refining margin, but it does increase the upside risk for crude degummed basis in central Illinois and more broadly as well. So this is one where I wouldn't be surprised if let's just say that soybean oil futures forecast kind of remains around 50 cents. It wouldn't necessarily surprise me if the crude basis rose and ended up being 5, 7, or 10 cents above futures, just depending on how strong that demand is going forward, and how much of the renewable diesel industry uses crude degummed versus, or buys crude degummed versus RBD. And again, like RBD, the basis is up slightly for both the quarter and the year so far. All right, finally, canola oil. This is for our assessment in Los Angeles. We are working on getting an assessment for our assessment for Chicago back up. I think they are getting pretty close to getting the Chicago assessment back up, which I know will make a lot of people happy and will make me happy. And we're also working on getting assessments done in some other locations that will make a lot of sense going forward. Those probably will take a little bit longer. The Los Angeles market or the West Coast market, I still think is really important because one, there's a lot of trade that flows on the West Coast from Canada into the US, and I think that probably will continue. I think originally sort of 4 or 5 years ago when we really started diving deeply into this space, I think that we had anticipated that co-processing would be a more significant contributor to renewable diesel capacity than it's turned out to be. And so initially we kind of thought that that would be really important and would drive a lot more canola oil demand than what we've seen so far. And it doesn't look like co-processing is going to be a huge contributor to the overall capacity. So I don't think that like is reflected in our supply and demand forecast. I don't think we're going to see kind of huge growth in canola oil usage in bio or in renewable diesel production. But I still think that West Coast market's important. That said, I really want a Chicago price because comparing RBD soybean oil and RBD canola oil in Central Illinois and Los Angeles doesn't really give us a great sense of where that spread is. I mean, it gives us a sense, and we can say, oh, well, based on if it's, if the canola oil premium is a penny, we can say pretty confidently that soybean oil is probably trading at a premium to canola oil, but it'll be much better once we get that Chicago assessment back up and running. All that said, you can see canola oil prices have been sort of straight down since peaking about a year ago. And like the other ones, I think we probably are getting close to that longer term equilibrium. The one thing that I would say is that the relative move in canola oil versus soybean oil, and the fact that soybean oil kind of is probably trading close to or at a premium to canola oil right now, means that there probably is maybe a little bit more upside price risk for canola oil in the longer term than there is for soybean oil. However, it may be that if the demand for soybean oil from both renewable diesel producers grows as much as we expect, and non-biofuel demand doesn't really decline at all, that relationship may shift. I think in the long term, I think there are reasons that canola oil trades at a premium to soybean oil, and so I would expect that premium would return at some point. It just may return at a level that's a little bit lower than we have seen historically. All that said, we've got canola oil kind of around 70 cents roughly over the next year in the Los Angeles market. All right, that is it. So I've got one question, and then I'm going to have to run to the airport. When forecasting soybean oil nearby futures out to 2024, how do you know the direction of the basis in relation to the spot price, or does that not matter? The way that we kind of do our forecast is there are a couple of ways that we do it. I think probably the easiest way to think about the way that we do it is we look at the soybean oil futures and determine a direction from that, and then based in part on that, we forecast basis. Now, that's not entirely 100% true. what we ultimately really do is we have a model for futures and we have a model for basis levels. However, if the basis model were to get really out of line with futures, I think I probably would favor the futures market in the basis model. That doesn't hold all of the time, and there are good reasons that basis might differ wildly from futures. Basis can go down, and while futures are steady or moving higher. But I think that a lot of times, and in a former life, one of the things that we looked at to really guide us in our futures trading actually was sort of the opposite of the way that we look at it, but we looked at basis levels at various points in the country as representations of the supply and demand balance for certain markets. So the basis in the Gulf represents the export demand. The basis in Central Illinois represents the biodiesel demand or the non-biofuel demand. And we kind of looked at those and then use those to forecast futures. So ultimately, there are a lot of different ways that you can approach this, and I think it's probably, I'm not sure that there's a correct way to do this. I think that it's finding a way that you are comfortable with. However, I'm more than happy to kind of show you the way that we approach it, and kind of go through it step by step with you if you are curious, and talk about some of the assumptions that go into our basis forecast. But they aren't, while they are kind of related, and we do look at the relationship to make sure that we think that it makes sense given what we know is going on in the market. They don't always have to be related at all. Do you forecast RBD canola as a freight diff to Chicago or other parameters too? We forecast RBD canola as a function of the historical Los Angeles price and the fundamentals for canola broadly. We refine it a little bit based on what we think is happening in the West Coast market. But very broadly, the first cut is really the historical RBD series that we have for Los Angeles against the historical US fundamentals that we look at. So we don't necessarily look at it as a freight differential. I will say we do kind of look at the freight differential in a way, because we compare the price of soybean oil in Central Illinois to the price of canola oil in Los Angeles. We look at that spread as part of the forecasting process, and we have an opinion on sort of where we think that spread is going to go. And so from that perspective, it's a little bit, but it's not quite as straightforward as just kind of saying, okay, here's the Chicago price, and based on the freight differential, here's the LA price. If we had a Chicago price assessment, I would probably favor forecasting in Chicago. However, the reason that we stopped publishing a Chicago price was because we weren't getting enough, we weren't getting a sufficient volume of reports to make the price reporters confident in the numbers. And so given that history, I would probably almost do it the opposite way, where I would look at the LA number and then maybe take a freight differential to Chicago to come up with a Chicago price. But it would be sort of in reverse. Instead of adding a freight differential, I would probably subtract a freight differential from LA to get a Chicago price until I was confident that we were getting a sufficient volume of reporting in Chicago to actually sort of reflect the price there to a degree that I felt like it was robust enough that whatever the deviations sort of historically, they weren't impacting the forecast, if if that kind of makes sense. And given the long history in LA and the relative volume of reports in LA, I sort of, not that I don't trust any of our numbers, but I sort of trust those numbers a little bit more than I probably will once we get Chicago. I think the Chicago numbers will be accurate. Please don't misunderstand what I'm saying. It's just that given the gap in the history, they'll need to be more accurate, or there'll need to be a significant period of time where I can establish a relationship before I forecast kind of using the Chicago numbers. You mentioned non-biodiesel usage and food usage. Are these not the same thing? How do they differ? So soybean oil or the veg oils, or the veg oils and the fats and greases are used in all kinds of things. So the bulk of the usage is in food usage. So soybean oil or canola oils and mayonnaise and salad dressings and almost anything that you buy. And that makes up the vast majority in most cases for the usage. However, it's also used in plastics, and UCO is used in furniture polish remover and other weird things that you wouldn't think of when thinking of vegetable oils or the biofuel feedstocks. And so there is a significant portion of that non-biodiesel demand that is not food usage either, and it varies a little bit by commodity, and we don't really get good data on the actual food usage or non-food usage. There are a couple of different ways that we tend to estimate those numbers. But it's a significant, either way, it's a significant portion of the overall demand. The main reason that I don't include that I don't break down the non-biodiesel usage in most of the balance sheets that I show is because we don't really have good numbers to reconcile to. So so for exports, I get Census Bureau data that at the end of the day, I trust and believe and can say, okay, this is accurate. I know that this is the number. It may get revised at some point, or there are things that can happen to that number. But when the Census Bureau reports it, the market and everybody believes that is actually the number. If I publish the breakdown of non-biodiesel usage for food and non-food, it's just really my opinion of what it is. And so we do know that the total is sort of the actual number, although the total is a residual number. So even the total is a little suspect. And because of that, because of those two things, I just don't publish the breakdown. However, if you want to kind of talk about that sometime, please send me an email. I'm always happy to spend some time answering some questions from you guys, because I always really appreciate it, and I usually get something out of the questions. Okay. That is it for this week. Like I said, no webinar next week. I will post something going forward every week, even if it's just a paragraph, to say that I'm not posting anything else, and the numbers have been updated, so that one, the numbers will update, and two, you'll know that that the forecasts and the other data have been updated on the website. I'm surprised that it's taken me this long to learn that. Anyway, hope to see you all at the conference next week. Everybody have a great weekend in between, and I will talk to a bunch of you next week. Bye-bye.